Not all accounts are created equal. What am I talking about? Taxes and investing. Stay tuned. I wanted to give an overview of taxation around investments. And the big reason I want to do so is I've been getting a lot of questions around, should I be investing in property? Is this the right time to buy? How does that work in conjunction with my investments? Should I sell certain investments? Well, the answer to all that is it depends. Because the tax code is so complex, there are a number of different rules that apply to different types of accounts. So this week, I wanted to review what types of accounts are taxed and at what rate those accounts are taxed at, because it's going to vary. Additionally, get into some of the strategies that we like to use to continue to avoid taxes and to minimize the tax burden when you are investing. So if we take a look at this slide here, I've laid out the types of accounts. And if you're listening to the podcast, I got 3 different sections. So this screen shows the types of accounts by retirement accounts, which includes your IRAs, your 401ks, your Roths, your SEP IRAs, your 403bs, basically any what we consider qualified plan or retirement accounts. The next section, we have taxable accounts. So these are perhaps a trust account, a brokerage account, which is just a typical investment account, and a savings account. And the last one here is real estate, rental property, along with whatever other property, could be commercial property and the like. So each one of these accounts within this framework is going to be taxed differently. And how do we maximize the value out of each one of those accounts? Well, it's not so simple, right? So the first one we'll start off with are retirement accounts. So again, think about your 401ks, your IRAs. You are not taxed until you take money out. Now, Roth IRAs are completely separate because you were already taxed with the money going into the account. So when you go to take the money out, you're not taxed on that income. However, there are some exceptions if you take the money out early and for some other reasons. But for this example, think of retirement accounts as mainly your 401ks, your IRAs, your SEP IRAs, your 403bs, your 457s, right? So whenever you take a distribution, whenever you take money out of the account, which means coming from that IRA and goes into your bank account via check, electronic transfer, you are going to be taxed in that year based on your income. And on this slide, I have taxed at ordinary income rate. What do I mean by ordinary income rate? So ordinary income rate is the rate at which your income is going to be applied to based on the tax tables for that given year. Now that sounds confusing, but in reality, just think of it as you are getting a paycheck, right? When you're working, you get the W-2 at the end of the year if you're salaried. It shows you the amount that you were paid, the amount of deductions that you've had out of it. That goes into your tax return when you go to file it. And when you take money out of your IRA or 401k, that money is essentially going to be the exact same. You're going to get a form at the end of the year, a 1099-R, which is an IRS form that codes the distribution coming out of your retirement accounts as taxable. So that money that you received from that account will go down on your tax return as what we call ordinary income. Now keep in mind, because I get this question a lot, you're not taxed if you just buy or sell investments within that account. Because it's a qualified account and it has some nice tax benefits, we can buy and sell as much as we want without creating any taxes because it's sheltered within that account. So keep that in mind. Only when you take distributions will you be taxed on that income. So how does this differ from the second set or the second group of accounts? So your taxable accounts, keep in mind, are trust accounts, brokerage accounts, and even savings accounts, because with savings accounts, you can still have interest coming from that savings account. So the taxable accounts will be taxed when you realize some interest, aka interest from a savings account. You'll realize taxes when you realize some dividends. So if you're invested in a stock or in a particular mutual fund or an ETF and they pay out a dividend, you are taxed on that dividend. And then you are also taxed when you sell that investment, whether it's at a gain or a loss. Now, obviously, if you sell an investment at a loss, although it's not great to sell things at a loss, it can be helpful to offset maybe a gain or some income at the end of the year. But typically, if you're going to be selling something, it's going to work out to a gain. And so that will count as income. Now, when we say you realize a gain or a loss, there's a different tax table at which that gain or loss will apply to. So when you realize a gain in a taxable account, it will fall under a different tax bracket. And this is the big thing that people get confused about. They think that it's going to automatically fall under their ordinary income tax rate. So again, when you get a paycheck, that is ordinary income. It is not considered a capital gain. So when you sell your investments in a taxable account, that is considered a capital gain. And on this screen, you'll see it here. I got two different graphs pulled up. There's an individual tax table and a married filing jointly tax table. Both of these graphs show you two separate tax brackets. Now, the married filing jointly, you'll see that on this left-hand side, it lists income from $19,000 all the way up to $612,000. So the ordinary income tax rates start at technically 0%, and then the 10% bracket kicks in on your income at $19,400. Then it'll jump up to this 37% bracket. These are, I think, 2 years old, so not super up to date. However, it gives you the idea. The capital gains tax rate is completely separate. It still applies when you realize a gain or loss to a taxable account. So on this graph, you'll see it in orange. The 0% capital gains rate for a married filing jointly couple won't start until $78,750. Right now, I just want you to understand that there's two different brackets. Okay, there's your ordinary income bracket and there's your capital gains tax bracket. Now, there's one other type of taxable accounts. So we talked about retirement plans. We talked about taxable accounts. The last one is real estate. So real estate is in both brackets, depending on what the outcome of the real estate investment is. For example, you can be taxed and realize income or loss through the renting of your property. And when you do that, that'll count as ordinary income, right? It's going to flow on that side of your tax bracket. However, when you go to sell that property and hopefully sell it at a gain, as long as you hold it long enough, that will count under the capital gains tax bracket. Now, there are actually another set of rules for what will qualify as a capital gain. And the rule goes, if it's property or if it's a taxable account and you've held it for longer than a year, then it will fall under the capital gain tax bracket. However, if you've held on to it less than a year, for example, if you bought a stock in the last 2 weeks and you've turned around and sold it in your brokerage account, well, that's less than 1 year. So that will qualify under your regular tax bracket, as if you got a paycheck. Again, two different brackets, ordinary income or capital gain. So it will depend on how long you've held on to that investment. And this rule will apply to both real estate and the taxable accounts. Because again, if you're selling at a gain or a loss on a taxable account, or you're selling at a gain or a loss on their property, as long as you've held it longer than a year, you will fall under the capital gains tax rate. So something to keep in mind. And I think this is one of the fallacies, again, of the whole idea behind this big push for Bitcoin and for day trading, right? People don't factor in the taxes that go along with that. And not only those items, but real estate in general. If you're buying, flipping houses, that becomes very challenging. But if you're not holding on to these things longer than a year, then they can easily fall into your ordinary income tax bracket. And that bracket can jump up very quickly as well. So you could be paying up to 35-40% of that return. And there goes almost half of your return. So it's something that you have to always consider when going through the strategy of where am I going to invest and what's the best possible way to shelter from this taxation. And so that brings us to this idea and this thought. How do we save money on taxes, especially as we're investing? Because taxes can easily, as you can tell, chip away at the returns that we're making, right? Even if we're in the long-term capital gains tax bracket, upwards of 20% of our return, that can be a big hit to our investment, especially if we're doing something big like real estate and where the market has gone the last couple of years, everything has skyrocketed. And so if you're sitting on a huge return, you're going to most likely get pushed into a 20% bracket, and that'll definitely eat into your return. So from our perspective and our view, what are the best ways to avoid the taxation? Well, it's a combination of a few things. The first is it's nice to have separate buckets. So if you can engineer it, you're investing not only in retirement accounts, but you're also investing in taxable accounts. Real estate's a whole nother animal, but you're still investing in kind of diversifying not only your investments, you're diversifying your buckets, the accounts of which you're going to draw down from. And so having some flexibility in any given year can create scenarios where you can lower taxation depending on where your income falls for the year. So nothing is ever as simple as just take the income because it'll be easy, you just pay the taxes today and don't worry about it. Well, there's always a cost to doing things simple, right? And sometimes it's a big cost or sometimes it's little cost. But you have to start considering and thinking about what is the taxable impact, because even though you can generate a return on your investment, when you go to take that money out, there's going to be some kind of tax consequence. And the best way to mitigate that is to have different buckets for each different type of accounts. And one of the biggest things that we've talked about and shared with clients is this idea that if you do have investments that you've held in a taxable account, such as a trust that you've held on to for, say, 5 to 10 years, and we haven't realized any gain, well, there's going to be some opportunity in that. If you have some down income years, we can realize some capital gains because you're in a lower bracket and the capital gains rate bracket is working in your favor, right? And you can see that here on the screen that it shows as a married filing jointly or even as a single, right? The top capital gains rate bracket is 20%. So even if your income is above $168,000, right, your still maximum capital gains rate is 20%. And so there's some good value to realize some capital gains depending on, again, where you sit for the year, what taxes look like in the future. And that's probably one of the biggest areas that you can save money on taxes is the timing of when you want to realize that gain or that loss. Right. Think about if you've realized a big gain from a property and maybe you're sitting on some losses in investment accounts. Well, you can realize some of those losses to offset some of the gains from that property sale. So there are little ways for us to add value by determining what the tax strategy is within the investments. The investments within themselves are a completely different strategy. as opposed to how we're going to realize the taxes around that particular account. And I think this is one of the biggest things that investors overlook, whether it's in the news or you're talking to your friends. One of the biggest things that people miss are the taxes in the end, because that's one of the things that's never talked about. And taxes have become so personal to where we don't share all of our information, or, I'm at this tax rate, yada, yada. However, taxes can directly impact the return. And so when you see these stories about people making, $500,000 on their Bitcoin or $500,000 from some stock that went up over 2 weeks, well, if they turn around and sell that thing, that's all going to go down as income. And at least here in the US, if they're single, they're going to be in the 37% plus probably some kind of state income tax. And that's upwards of, at that rate, 50% tax bracket. So it's not so simple and it's not so condensed, at least when you see in the headlines or hear from your friends that, oh, hey, I made a 10% return. No, there's actually a taxation effect to that. And as a planner, as a financial advisor, that's always baked into what we're considering when we're talking about return projections, when we're talking about planning for the future, right? It's not something that we look backwards as a whole and say, well, we need to only realize X amount of taxes this year because you already paid so much. No, we're looking out 5, 10, 15 years ahead to say, we see some things coming down the pipeline, aka maybe you're going to turn on some required distributions, or Social Security is going to come on and it's going to bump up your tax rate. So taxes can definitely be one area that we can save money, that we can help monitor and create the most value for the timing of when we realize taxes. Investments are always going to be the hardest thing to try and time, whether to buy, to sell, right? But taxes can give us the definitive, yes, let's realize some taxes today versus tomorrow or the prior years. So think about that when you're talking to your friends, when you're going through the investment conversation. I've had a lot of conversations around real estate and how do I calculate the returns? What does that look like? And I'll probably have to create a whole nother video on that because I got a lot to say. But it's never as simple as, I'm covering the monthly mortgage, or I found an investment that works really well. Well, what are the tax implications behind that? Because as I've laid out, there's going to be different tax implications depending on how long you hold the investment and what type of investment account it's in. So I hope this is helpful. I hope this at least taught you something. You learned something. We go through this sometimes in some of the meetings, but I just wanted to create an overview. We don't take them lightly. We want to do some analysis to make sure that we're looking at all the possibilities so that we can save the most amount on your taxes going forward. So if you like the video, give it a like. If you're on the podcast, make sure you're subscribed so you get the weekly updates. Please share with your friends, especially those who are telling you that they're killing it in the investment space and they probably have no idea what the tax implications are. We'd love to sit down and share with them some of this information, or just share with them this information so that they know that there's some other things to think about other than, is this a good investment or not? So I hope you have a great weekend. Happy Easter to all of you. And until next time, take care.